hedge fund fees are not compatible with large AUM. The fee is too high, and then the hedge fund structure is too tax inefficient. So instead, you can have the sort of larger scale portion of your strategy and put that sleeve into an ETF. And then you're charging a way lower fee than the hedge fund. And then if the ETF holder, if they don't sell their ETF, and if you don't have any distributions in the ETF, then they can keep deferring taxes for years.
Welcome to the special bonus episode of Other People's Money. I'm sitting down again with David Orr. We had him on recently to talk about his hedge fund business, but we're doing this special episode because he also has a long short equity ETF, ticker ORR. It's the Militia ETF that you are the portfolio manager of. It's not very common for people to have hedge fund business and an ETF, especially one that, although I know the portfolio is not the same, but you run long short on both sides. So I was really excited to sit down and talk with you about why you made this decision to launch the ETF, how it differs from what you're doing in the hedge fund business, and all the other considerations that come with running money in this type of vehicle.
Mhm.
So thank you for doing this. And I guess let's just start with the decision. Why did you want to launch an ETF?
Yeah, I have this idea that hedge fund fees are not compatible with large AUM. The fee is too high, and then the hedge fund structure is too tax inefficient. Um, so instead, you can have the sort of larger scale portion of your strategy and put that sleeve into an ETF. And then, you're charging a way lower fee than the hedge fund. And then if the ETF holder, if they don't sell their ETF, and if you don't have any distributions in the ETF, then they can keep deferring taxes for years. So there's a huge tax advantage from ETFs as well. So it's that combination that it's like a no-brainer to me. I actually think if this is successful, lots of people will start copying what I'm doing.
Well, I guess obviously the big concern people have is the hedge fund fees are extremely lucrative. It's if you could have, $1 billion in your hedge fund with hedge fund fees or $1 billion in an ETF with just management fees and, the increased overhead that comes with running a much more highly regulated product. Um, I think anybody would choose to have it in the private fund.
Mhm.
So cannibalism of AUM is a huge concern for a lot of people.
If a fund is trying to raise as much AUM as possible, so some hedge funds are like this, they're pure marketing vehicles. In that instance, yeah, I guess fair enough, go try to suck every dollar you can into the hedge fund. But if you're a guy who cares about performance and adding value to people, that should be the main variable. And actually, these are two very different businesses, even from a pure like selfishness standpoint. Okay. If you're a genius marketer and you can get $5 billion into a marketing hedge fund, I guess good for you. Okay. But that's different than a performance oriented hedge fund manager. And usually these guys are introverted and pretty autistic and everything. And they're not going to do the marketing angle. So what the investor cares about is the actual investment value add. Okay. So if you're thinking about how often hedge funds shut down, it happens all the time. These things don't have that long of a business life. Okay. And that's because the edge slips. But what if instead you had a small scale hedge fund that kept its big edge? So that business is more robust. It's going to last way longer. And then you have an ETF that the fee is so damn low, then the investors, and they're not paying tax every year. The investors are just going to look at it and say, oh, okay, well, I can just sort of accept that the edge is way smaller because he's still adding small value. Um, and then another benefit too, from a business standpoint, is once your investor is like been long your ETF and let's say it's up 100%, they have a tax decision now. If they decide to quit your ETF, there's a big tax hit for them. So this is a way more sticky customer, and it's a rational stickiness too. It's not like just um, like you've trapped somebody in something that's hurting them. It's like you've trapped them in something that's like a golden handcuffs that's actually good for them. So, and then another, like in the economics of it, you can actually like once your AUM of the ETF grows really large, you can start doing things like sell a piece of it or get a loan against the income stream because it's so predictable. So there's other ways to actually cash out really big. In my case, maybe someday we've been discussing maybe turning it into a public company someday once it gets big enough, for instance. And there's a lot of different ways you can make money in that, and it's way more durable. So the whole picture of it, yeah, the headline, you didn't get the huge performance fee for those 2 years before you shut down. It's not as exciting, but if you look at it long term, it's like pretty damn awesome.
Another problem that I've heard about from people is that allocators, investors, they like things to be as they have been. To underwrite like a new structure is work. So, if a long short hedge fund manager with traditional hedge fund fees comes to them, like that's something they've looked at before, they've understood it. The investment committee gets that business. In theory, bringing them a vehicle that has just as good a performance and has lower fees should be attractive to them. But it's a new thing that they
Yeah.
have to bet on, that they have to say, "Well, we think that we're gonna go this way that is untested and potentially has career risk."
Yeah.
How has this structure been received by, this more investment committee class of investors?
Yeah. It's even actually worse than you're saying because you're not even telling them it's the same return, right? I think the edge will be lower in an ETF vehicle. So you're actually telling them, hey, you're going to buy this investment that has a worse return, worse expected return. So yeah, you have to sell them on this new thing. But setting up an ETF is not that expensive too. So if you already have like a large, super traditional hedge fund, and maybe you're worried that your investors will see this ETF thing and actually quit your hedge fund and not buy your ETF, if those are your kind of LPs, then sure, it doesn't make sense to try this. But if on the other hand, you think your LPs are sort of neutral or maybe curious, like you're saying, cautious, they're not going to jump on it. But the ETF's nice. You just start running it. And then if it starts performing well, word gets around and alpha attracts money pretty quickly. So you don't really have to even, you're almost diversifying your business too, right? You don't even have to know or care about where the money comes from. If people are buying your ETF and it's a different set of investors, that's a great thing, in my opinion, from a business standpoint. Yeah.
Well, it's interesting with ETFs because you don't know where it all depends on what your distribution channels are. Like, if you're doing a lot of outbound sales where you're sending a guy on the road and he's going to sit in the offices of, like, these big RIAs and convince them that your ETF, should be a position in all of their clients' portfolios. Yeah, and then, suddenly a big create happens and you create a bunch of shares because you get inflows, like, you can maybe track where that's coming from, but a lot of times you can't.
Hmm.
How different is that from running private capital where every investor, you have to approve them?
Yeah, it's totally different. So there was like I don't even know who it was still. Somebody bought some crazy amount of the ETF in early February when we first launched. I don't know who that is still. And whoever, if you're listening, thank you. But um but other guys I do know because they're like, hey, I'm an RIA. We have X billion of assets under management. We're curious about your thing. And then we'll do like a 30-minute call. And then they'll be like, yeah, okay, I'll buy, a chunk of your thing and we'll see how it goes. And in some cases, they've said to me, I don't have too many calls, but, I've had maybe 5 or 8 calls, something in that range. And they'll tell me, oh, I'll tell my other RIA friends. So you sort of have a rough idea of where the bigger money comes from. I think the smaller retail investors, at first, they don't move the needle. But long term, if you perform well, even they will move the needle like they did for ARC, certainly. And so why wouldn't they for like a well, strong performing ETF that's more fundamentally sound too? They're the same thing to them. They just want to make money.
Well, ARK was also they were impacting the names that they owned.
Yeah,
You could definitely argue that the inflows there moved the price
that's
around.
true.
How are you making sure that your inflows aren't moving the price around? What are you doing to match the liquidity of this vehicle with the liquidity of your names?
Yeah, so I'm doing it 2 ways. You have the, average daily volume. You wanna be sure that the daily volume that's buying or, the OR ETF, they're not gonna push the individual stocks up. That's just based on your percent position size and the underlying stock versus the daily inflow. So we basically have it so if the daily inflows doubled from here, then you'd be most likely fine for most of the companies. So that's pretty conservative, right? Because we're only half of that layer. Um, and then as it grows, you also need to be worried about, you don't want to own too many of the day's volume. And because the fund did grow so fast, it grew faster than I expected. Um, a few of the positions are maybe a little too big, but they're really small percent positions. The vast majority of the portfolio is completely fine that way, but we track it both ways.
Let's say that you started to get more traction and that average daily volume started to creep up. Like, would you have to adjust the portfolio? Would you adjust the strategy? And I know the idea here is that this is scalable. Like, is there an upper bound?
Yeah, you just sort of keep adjusting this liquidity of each underlying stock. I have ideas about how to broaden it, so I'd go into some other markets like, um, yeah, like maybe Philippines or Korea, places like that. You could find more of these kind of illiquid microcap, because that's a nice benefit of the small AUM is you have these really illiquid companies at first, and they're really small bets, but the huge basket of them, it does move the needle. And then the way I've structured it, most of those bets will be fine to like 300, 500 million. We'd have to trim a few percent, 5%, something at those layers. But as the percent, we're like what, 135% long or so right now. So, as a percent of the portfolio, it doesn't change too much, even at 500 million. I think maybe it would be less than 10% different. And then, yeah, if it starts growing fast from there, then the difference starts becoming more pronounced for sure. Then even some of these more like liquid $5 billion companies, you have to at least start thinking about it.
I'd be interested, are there restrictions on how levered you can be? Like as a hedge fund, you're restricted to you know, what your brokers will allow you and what your LPs will allow you.
Yeah,
What about ETF world? What rules do you have
the
around that?
bottleneck right now is just the broker. They're giving us the amount of leverage they're giving us because it's also new for them. They don't really, we're sort of the guinea pig customer on this. Um, and yeah, so they give us way, way less margin than they would a normal levered account, because I think they just want to see how it works for a year or two first. And then after that, I think we're allowed to run up to, I forgot the exact percents we put in the prospectus, but we can actually just change that later too. But I have it in mind to do more like, not too levered. It'd be a lot less leverage than the hedge fund. Cause I don't think, an ETF vehicle is good for you lose sort of the nimbleness in the trading. And if you're running with lots of leverage, you want a nimbleness if you need it. So
What is the typical leverage you foresee as the fund grows?
I'd probably aim for about 200% gross leverage, which is about what we've had. So I don't if the broker did give us more margin someday, I don't really think we're going to increase it much.
So obviously you have to file a prospectus different than a private fund. Do you state goals there, like what your investment objectives are and the outcomes you're trying to achieve in the same way you would like a launch letter for a hedge fund?
Yeah, pretty much. Yeah, we're just saying what the goals are. Like, this is a fundamental based. I'm looking at the underlying cash flows of the businesses that I'm betting on, that kind of thing.
Do you select a benchmark in the same way or not?
I don't think we selected a benchmark. I don't know.
With those investors that you have had the opportunity to speak with, what is it that they're looking for from this ETF to get? Is it lack of correlation? Is it absolute return? Are they betting, okay, I think this is somebody who can beat the market, or they like the fact that it's uncorrelated or lower? I mean, I've looked at it. It's generally lower volatility than the market.
Mhm. Yeah, I think just different people have different reasons. I've heard some people say they like the Japanese exposure. I had a big allocator reach out recently, and he said he's just looking for more active Japanese funds. And he says doesn't even seem to like the other portion of what I do, but he really, really likes the Japanese part. So he's thinking, well, maybe I'll buy it anyway. Uh, and then, yeah, other guys, they think there might be alpha. Other guys, yeah, they like the less volatility. Some people like the efficiency because the ETF gives you good margin. Um, Yeah, it's all sorts of reasons. So, and other people, yeah,
Are
some
you
people like owning it on margin or in a retirement account.
are you concerned at all about, just the transparency that the ETF has and all your holdings are available daily? If there proves to be alpha over time, wouldn't, in theory, people start to size up, the same trades you're putting on?
Yeah, I thought about that. Like, if they're just copying the trades, that's sort of good because, then they're sort of pushing the stock in our favor if we're already in it. So that's just seems like a straight up positive if they do it. And then if they're doing it, like, say, systematically with all of the positions, most likely it doesn't make sense tax wise if they're taxable. So they wouldn't do it for that reason. It doesn't make sense. Like, if I quit a position, then they're going to have to quit after me after, I've already maybe pushed the price a little bit. And then there's sort of a liquidity vacuum there probably for a while. And then, so that's the portion of it existing positions. Later on, if we have to like build positions or quit positions more gradually, and let's say people try to front run this, they're going to get slaughtered there because there's strategies you can do to mislead them, and you can sort of actually trick them into, because I have all the information, right? They don't actually know what I intend to do or not do. Um, so yeah, they can't really beat you that way either.
Now, what about the marketing side? Now, in our conversation about the hedge fund, we talked about the fact that you selected 506C. It allows you the ability to, broadly solicit and market that fund. People believe that ETFs are, because they're public securities, and you can see the track records out, that they're easier, maybe less compliance. As you've been in both worlds, knowing what you know now, is that really the case? Are ETFs less compliance or more compliance?
Um, it's hard to say because my hedge fund is so damn like, I'm basically reading the law and I'm being not super aggressive, but I'm basically saying, well, here's what the law actually says. Here's what we're doing. And so I sort of get to decide that on my own. And so in real time, if I want to post something about a hedge fund idea or something like this, I can just post it. There's no like compliance committee. But with the ETF, because we're going through ETF Architect, and I've liked working with them. To be clear, overall, it's been a great experience. But their compliance department is definitely looking out for their company. They're not looking out for my freedom of speech, right? So there's a different standard there. I think if somebody had if they were just sort of going with what all of the compliance consultants were saying for a hedge fund, it'd probably be very similar.
Why did you choose to then go with like an ETF architect versus truly, in our conversation, you said you really value the ability to speak out on your own, and that if it came down to it, you might even close the fund rather than change what you say. But
Yeah,
here,
so they're not really limiting what I say generally, and if they said I can't someday, I'd say, this just won't work out then. But they're saying that I can't talk about the ETF, publicly without their approval of every single post instead. But that's fine. I just don't have to talk about the ETF. It actually is kind of lousy for the ETF investors because if they ask a question, then I basically can't answer it. Um, but you know, for me, it's not really changing much at all of what I can say because I can still talk about the hedge fund and I can still talk about the companies. Um, but yeah, if someday they said you can't talk about companies and there's a problem here, I'd say, all right, well, we got to find a solution here because I'm not going to do that.
as you said, people ask questions sometimes and it's difficult to answer. Has that created friction? I mean, it's easy for us to sort of understand that being close enough to it, but oftentimes retail investors and even, RIAs who just aren't issuing securities don't quite understand the rules around it. How do you communicate your restrictions to people so that they don't think you're dodging questions, given your openness in so many other areas?
Yeah, I have the pinned tweet, which we got approval early on when we launched the ETF. I try to explain in that explanation um, that I can't reply to questions. That's why. I hope people understand that. I'd be happy to answer more questions and everything more freely, but I basically can't. So
What is the distribution plan, marketing plan for the ETF? Are you just trying to let performance speak for itself, or do you have a sales team? And is that something that comes with partnering with somebody like ETF Architect, or something you have to do for yourself?
No, basically I partnered with one of my big hedge fund investors, one of my day one investors, and he knows some pretty wealthy people privately, so he could sort of tell them because we needed ETFs need some capital to get the ball rolling, a minimum floor. I also need to help operationally. I can't sort of do everything, but he can sort of take care of most of the things on that side. So there's a little bit of marketing coming from him. But besides that, we said to each other early on, performance is the marketing. And I told him, if it doesn't perform well, I'm just going to shut it down. I don't want to, if I'm missing something in this model, if the ETF can't have an edge like the hedge fund can, then I don't want to do it.
And with that seed capital to sort of stand it up, do you have to give up a piece of the business? And then likewise with somebody like ETF Architect, like are they becoming owners, or is it more like they have rights to revenue? How does that work?
Yeah. So my business partner, he has 30% of the business. I did that because I didn't want to deal with the operations. Now that we can see that the ETF is very successful, he got a good deal. But a lot of the time he was going to go through a lot of brain damage. And he also, it wasn't a huge cost, but he fronted the money and he went through a lot of, getting his investor circle involved. So in the bad outcome, he would have gone through all that and had nothing to show for it. So yeah, so he has 30% of the economics there. And then the ETF architect, they get like a really small, it really just covers costs mostly. Like their profit is very, very slim. And yeah, we're paying for that, not the ETF investors.
So how does a business like ETF Architect work? Are they mostly making it on like standing it up? Like there's fees for actually getting it off the ground, and then keeping it running is more low cost?
Yeah, it's just there's like trader costs and legal costs, and we have like a board and stuff like this. So there's definitely more a bit more cost than a hedge fund. For like a long only US ETF, I think the annual cost is maybe 170 grand a year. But because we're doing the long short one, it's like 250 grand a year. And yeah, they're mostly charging costs. I don't know what their margins are exactly, but I get the feeling it's a home run kind of business where even though their percent take at the end is really small, really toward the end, it's just every incremental dollar is more profit for them. I think not all of it, but a lot of it.
Now, what about the gross expense ratio? I've seen you comment on this. I think it's worth touching on. How do you, as an ETF, have to report your expenses in a way that is just so different than the way private funds do?
Yeah, so they basically in the ETF structure they butchered the expenses on short selling. So a short dividend expense is the big one. If you earn like when you short, I said in an earlier interview that I had like a positive carry on my shorts, but actually in the ETF expense, it doesn't count the positive part of that equation. It only counts the negative. So this is also just considered a cost. And then on top of that, you're paying some margin interest for the long. So that's another cost. So you have three costs and none of the offsetting factors, right? Because if you're a margin interest long to own something that's like got a let's use a real simple example like energy transfers like a 7 or 8% dividend yield, which is growing. Is that really a cost? It's like there's like it's a carry trade and there's some risk, but that's not a cost, right? It's not actually costing the ETF investors. Is how I see it. So yeah, the whole like, regulated way of reporting that ratio doesn't make any sense, and I would just tell them you guys should just change it so it gets the right number.
In the grand scheme of the financial ecosystem, are a small fish. You said you think that if this is successful, you might see more people. Is that what it's going to take to get this type of stuff changed? Just to have, bigger people, louder voices? I'm sure if BlackRock had a successful long short ETF,
Change
and
overnight.
they were getting gripes about the expense ratio reporting, the law would probably get changed.
Yeah, I mean, but for me, I don't really care because, the way I see it is, the the performance is gonna be what it is, and so if it performs well, then it doesn't really matter if it grows a bit slower than it would have, because the way exponential growth works, that's all that matters is if it's gonna keep growing exponentially or not, and already it's grown to a at a rate now where I'm already happy with it. So even if it didn't even keep growing this fast, even if it was like, or sorry, if it didn't grow faster than this, that'd be fine with me. Then we'd have like a small fund for years, and that'd almost be exciting because then the edge at this point, the smaller it is, uh, higher edge. So I think that's kind of cool too. So for me, I'm totally indifferent.
As of the day of recording, it's up over 100 million. Did you think you were going to be at 100 million in less than a year? What was success? What did it look like to you at the outset? The bull case, base case, and bear case.
I thought this would be the good outcome. But I thought half the time it would just fail. Um, I thought, like maybe people wouldn't be interested, or we also thought maybe operationally it wouldn't work early on. Um, and then like yeah, the first few days we launched it, there was very little interest. Nobody was really buying it much. So actually the first like week and a half, I thought, oh damn, it's gonna flop. But then, fortunately, Bill Martin, he showed up out of the woodwork and is like, "Hey guys, this guy's new ETF." And, people love raising capital. So uh, after that, like a ton of money started flowing in. So thanks to him, I didn't ask him to do it or anything. He just randomly did that for me. That was pretty sweet. Um, and then I think without that though, it would have been way, way, way slower going.
What is the break even point where you would have to say it's just not worth it to keep this thing open anymore? You hear a lot of different numbers thrown around. I imagine for a long short product, the costs are a little bit higher. So what is your break even like, and how long were you going to give yourself to get to that point?
You break even at about 20, $25 million. So, um, because our cost, yeah, is about quarter of a million a year. And then I figured, we were gonna hope it would perform well. And then if performance was going well, we didn't even care what the AUM was. At some point, we would just assume, that the AUM would come in. I just think that's a given, really. So for me, I wasn't really thinking about that. I was thinking more like, well, how's this thing in ETF structure going to perform? And also, I'd say we got really lucky on the timing because, you know, thus far, if you actually solve for the factor exposures, the alpha is really high. I think it's probably higher than is possible in the long run. I want to be pretty clear on that. I think we've had a good run here, guys, and you shouldn't expect this kind of alpha long term. I'm hoping more like if we can do 5 to 10% of your alpha, still that'd be fantastic. Even five would be fantastic. So in an ETF structure, um, so I think that's part of why we grew fast too. Is we got a lucky start because the hedge fund's been performing really well too over the same period. These things are kind of correlated. Um, and yeah, I don't always the hedge fund does well overall, but it doesn't always win this well.
How do you manage the two fiduciary responsibilities that you have and the trade management? Like, I know for hedge funds where it's all inside the same entity and you might have different strategies, you can kind of put in a trade and code it in a way that it's going out to both at the same time. But I imagine because these are separate entities, separate businesses, you're not able to put in trades that way. Who gets the first trade? If you're going to do the same trade in the same portfolio or in the same trade, relative to the size, how do you decide who gets
Yeah.
which
So
one?
technically, what we have to do is tell the ETF architect people like, hey, we want to do this trade. And once, they execute it at the end of the day, so we can sort of execute it at the same time. But in practice, I don't want to push the stocks around as much. So I just randomize it. So sometimes I quit more like earlier in the hedge fund, and sometimes I quit more in the ETF, and then I space it out a long time so that they're not, there's not like an overlap. And that's just being done to minimize the market impact. And then we have people reviewing it. So we're trying to make sure that overall one side isn't taking advantage of the other. Um, so that's sort of the system we have.
Is there clarity? Like, there aren't like set rules. Like, if you have two investment businesses, like you have to do things this way, or are you kind of setting your own rules and just trying to be ethical with it? And there's not clarity
Yeah,
on.
so the way I understood it from ETF Architect is once we put in the trade with them, then we're free to go on the hedge fund side. Because I don't do the physical trading or the trading in the ETF. It's somebody else. So it's not me actually clicking the button there, but in the hedge fund it is. So I think technically I could just do it the same day. Um, I don't really know who would benefit or not. Um, but in practice, I just try to space it out and randomize it. Because I'm not a super short-term trader most of the time, and short-term trades don't even go into the ETF structure because it doesn't fit there. So, for a longer term investment, what you actually care about is the liquidity and market impact. That's the variable that matters. So in that instance, there's not an issue by spacing these things out. So they couldn't possibly be impacting each other, as long as one's not constantly quitting before the other one or something. That's how I'm seeing it. I guess we'll see if the regulators yell at me. If so, because I actually think the way I'm doing it is better for the investors on both sides than me trying to quit it all the same day on both vehicles.
Do you have to declare your intentions, like, to that, "Hey, I am also going to trade this in the hedge fund." Like, obviously, you put the order in with your ETF guys. Do you also have to tell them, "Oh, and by the way, I'm probably gonna trade this name too
No,
in."
I don't have to tell them that.
Are there any other little quirky things that have come up that you didn't maybe even realize at the time when you launched?
One thing I've been impressed by, man, is just like the ETF traders, like on the illiquid stocks, they get so much better fills even on way higher volume. So I've actually seen these guys on Twitter debate like what percent of the daily volume you can take and not have, much of a market impact. And I was shocked. It was like smart people. And one's like, yeah, you want to stick with like 1% maybe, or maybe definitely less than two. Another guy's like, you can just totally do 8 or 10. And as a hedge fund trader, I'm like, 10? Wait, what? No way you could do 10. But dude, somehow these ETF traders, man, they find the liquidity and they don't move the stock at all. Like sometimes when I try to do it in my hedge fund, right? In these kind of illiquid Japanese stocks, if I'm selling or buying, I can actually see myself pushing it up against me in real time. But these guys somehow they're getting 10% of the volume, they get the exact close price, and the stock, like if they're buying, let's say, the stock will still have closed down that day. And if I was trying to buy 10% of the volume in the hedge fund, man, there's no way in hell the stock would close down that day. I would somehow screw it up, and so I'm actually like learning more about that, like kind of how the market makers have this better trading operation. And I'll try to sort of implement that actually into the hedge fund. I'm actually working on that right now. So
What is it that they do differently so far that you've come to the conclusion of?
I don't know how they do it exactly. I know that I'm in contact with the professional traders now, and they have these kind of relationship businesses um, with I think it's other market makers and things, and so these guys just have these inventories of stock because you know how market making works, right? You sort of sometimes get stuck with a short inventory, and sometimes you get stuck with a long inventory, and it's kind of random because they're just going after bid ask spreads. And so if you have a relationship with a market maker and you sort of ask around, I guess some guys just have inventory they want to get rid of, and then bam, there's your volume. So, and they give you whatever the closing price is.
How, as the hedge fund, are you gonna be able to enter that world? It seems like it's necessary for these guys for their business, and they're dealing with people who are in the same business, so it's a, "I scratch your back, you scratch mine."
No, they collect a fee. So you have to pay 5 basis points of the trade, which that doesn't make any sense at all for some like liquid American stock, right? That's like, 5 basis points down the drain. But for illiquid Japanese company, I mean, these things have like a really wide bid ask spread, and you're saving way, way more than 5 basis points. And they don't care because on the long run on their side, right, they're making their market making profits, and they're just happy to get rid of their inventory.
That makes sense. Well, I guess, what is next? You've crossed over this big $100 million benchmark in assets. Performance has gone better than you probably could have hoped.
Yeah.
What are you trying to do now to close out your first year, and maintain what you've built?
Yeah, I just keep trying to find stock ideas. Really the portfolios, I like the portfolio a lot today. I posted that the stats of the underlying stocks recently. And the valuations of these microcap Japanese things and even the US longs and all of it combined, I just really love the portfolio. So, I'm hoping that you know, I just hope we keep performing well on the back of fundamentals, and that's basically it. And I'll just keep trying to do that long term.
Very cool. Well, we'll leave it right there. And I guess I'm realizing as we say this, I should probably disclose I do own a little bit of OR for everybody
Cool.
who is listening.
Yeah.
So I am a holder, not in any sort of like big size, but I'm realizing I do kind of have a small conflict of interest here. So maybe just make that clear to everybody. Do your own due diligence, read the prospectus, yada yada yada, and yeah, I own the ETF. So David, we'll leave it right there.
Right.
Thank you so much.
Yeah. Thanks for having me, man.